Payback is only a rough estimate as to the acceptability of an investment, primarily because it doesn't take into account time value of money, and therefore the results of payback can be sometimes misleading. To do a more rigorous analysis of the investment, we need to calculate the present value, that means in current dollars, of all of the future returns from the investment. We can then take that value and compare it to our initial investment to see whether we're making money or losing money. The first thing we need to do is put into cell B11 the company's desired rate of return. That really represents the company's cost of capital. What does it cost the company to raise money to make investments? They can sell stock, incur long-term debt, use retained earnings, and in combination that results in a single discount rate, and we're going to enter for this situation a 10% desired rate of return. So in cell B11 I'm going to type in 0.1, enter that value, we have 10%. So for this company, any investment they engage in has to earn at least 10%, otherwise the company is losing money. Now I need to calculate the present value in current dollars of all of the future returns from the investment. So I'm going to click in cell B12, and I'm going to use the NPV function. So I'll click on Formulas, Financial. I'll scroll down till I get to NPV, click that. I have my function arguments window. The rate is going to be cell B11. That's the desired rate of return for the corporation. Value 1 are the yearly returns from year 1 through year 5. So that's the cell range B6 through F6. When I click the OK button, I see that the present value in current dollars of all of the future returns from the investment, those are the returns from year 1, 2, 3, 4, and 5. The current value in or the present value in current dollars of all those future returns is equal to $234,377. Now I make my comparison in cell B13. So I click in cell B13, I type in the equal sign, I point and click at cell A6 because that contains the initial investment. It's in red because it's a cash outflow. It's money leaving the company. So I click on cell A6 and then I add to that plus the net present value of all of the future cash returns. Remember, cell B12 represents in current dollars the value of all of the future returns. So when I click there, my formula is A6 plus B12. When I enter this formula, I have a positive value of $34,377. If my financial net present value is a positive number, then this is a good investment because the current value in current dollars of all the future returns from the investment are greater than the initial investment. If the financial net present value were a negative number, then that would mean that the present value in current dollars of all the future returns is less than the initial investment, and I would be losing money. So in this case, the financial net present value is positive, so this investment is acceptable.